because inventory must be sold. So that's why we have inventory in our balance sheet. We make the goods, and we make the goods with the intention to sell them, to create revenue, right? But still, unsold items are in inventory. So if I ask you which one is most liquid among inventories and account receivable, the most liquid is account receivable, and after that, inventory. And then equipment, buildings, they are even less liquid. Why? Because it takes more time to convert equipment and building into cash. Maybe it takes years to do that. Selling building is not an easy task. So assets and liabilities are reported according to their liquidity. So let's talk about this. So when you write down the assets, you classify the assets, current assets and long-term assets. Similarly, when you talk about the liabilities, you categorize the liabilities, current liabilities and long-term liabilities. The base through which these have two categories because of liquidity. Because current assets can be converted into cash in less than 1 year. Current liabilities are those liabilities which can be converted into cash in less than 1 year, which means these are those obligations which you pay in less than 1 year. Long-term assets, which takes more time to convert into cash. Long-term liabilities, it takes more than 1 year to convert into cash or pay after 1 year, right? So let's talk about current assets, right? So current assets converted to cash, sold or consumed during the next 12 months or within the accounting cycle, if the accounting cycle is longer than 1 year. Normally, it doesn't happen that accounting cycle is greater than 1 year. It is like 1 year. And then we have long-term asset, land, building, furniture, fixture, equipment. Long-term investments are also a part of the long-term assets, which include the investments in other companies. You purchase you purchase shares of other companies with intention for long-term holdings, right? And then current liabilities that must be paid within 1 year or within the accounting cycle. These are accounts payable, notes payable, salary payables, unearned revenue, interest payable, income tax payable, right? Similarly with the long-term liabilities, so all the liabilities that are not current, which cannot be satisfied in 1 year, are classified as long-term liability. For example, notes payable, if written for more than 1 year. Bank loan, right? Bonds, these are long-term liabilities. So format for financial statements. There are two formats in which a balance sheet can be reported. Number one is in a report format. Number two in account format. Similarly, the income statement also have the two format. Number one, single step format, and then multi-step format. You can choose either one of it. So here we go. So this is report format in report form, and in which you write it down that assets is equal to liabilities plus owner's equity, right? So you see assets, and among assets you classify it as current assets, and then you write it down according to the liquidity. So the most liquid asset is cash and cash equivalents, banks, right? Different currencies. Number two, short-term investments. You purchase other companies' shares for very short-term time, 2 months, 3 months. And then accounts receivable, then inventory, and then prepaids, right? And then you make total. So this total is the total of current assets. It's not like the prepaid and other. No, these are the total current assets, right? You write it down like this. And then we have long-term assets. So in the long-term assets, you write it down here, and then you add it up. These are long-term assets, and total assets will be current assets plus long-term assets. So our total assets, so the double line shows that this is the value of the assets here. Here we go. Now the next one is liabilities. So you write down the liabilities. Number one, current liability. So you see current liabilities total. So you write one line here, and then you add other long-term liabilities here, and then you add this amount and all these two. This become total liabilities. Similarly, with the common stock, additional paid-in capital, and all those stuff, you write it down like here. So you see here, total equity here, and this is the non-controlling interest. So that is in mergers and acquisition, when you control or when you purchase the shares in other companies, which is a huge part. For example, more than 5%, then you need to declare, because that becomes your own business as well, because you have a controlling share over there. You can influence their board of directors as well. So that's why this is written over there. So our total equity will be this one. So this amount, the double line here, it is the total of this liabilities and shareholder equity. And if you compare total asset, that double line here, this is exactly equal to liabilities plus honest equity. So this format is called report format. And what is the account format? It is like on the left hand side we have assets, on the right hand side we have liabilities and honest equity. So you see here, we start from the most liquid asset and then less liquid, right? And then we have total asset. Similarly, liabilities, we start from the most liquid, and then you need to have a one line here which shows the addition or the balance from the above. And then we have a stockholder equity, in which you mention here. So this section is now starting stockholder equity. And then the double line here. So it means you are adding those lines, double line, this line and this line, right? So did you see this value, retained earning value, is coming from closing accounts of revenue, expenses, and dividend. Okay, now income statement, single step statement, right? Single step statement. In single step statement, revenue minus expenses. That's it. Revenue, all revenues, service revenue, interest revenue, rent revenue, whatsoever, minus expenses, all those expenses. Then you have a net income. That's it. Right? But in case of multi-step, let me control here. Okay. So in multi-step format, you start with sales or revenue, and then you less cost of goods sold, it becomes gross profit. From gross profit, you less selling and admin and general expenses, and then you have EBIT or operating income or OI here. This is the financial term, so I'm just going to use operating income here. And then you less interest and then taxes, that become your net income. So in multi-step format, so you see more than one measure of profitability measures. Number one, gross profit, which is sales minus cost of sales, right? And then you less from the gross profit all the selling, admin, and journal expenses, not the interest, not the taxes. You find out the operating income, OI. And from OI, you less interest, and then in the income tax, you have net income, right? So this format is called multi-step format. So this format is, required for public limited company or corporation which are enlisted on stock exchange, right? So we have completed this chapter, and there's going to be assignment 3, which will be uploaded on WeChat as well, and I am also going to be uploaded this on Blackboard. And the next date is that this assignment going to be due is the next, which is I think on 21st, right? 21st of, let me see here. So 21st of April, right? Any question regarding our today's lecture?
Will our homework be about like closing books?
Yes. Our homework going to be, I'm going to give you 2 to 3 questions regarding you have to make the adjusted file balance as well. You need to make income statement, balance sheet as well.
Okay.
Okay. So basically all the things going to be revolving around, the adjusting entries. Okay. And Arani, any question?
No, sir.
Junpyo, Min, Minsu, Mishu, Misha, Sipode.
Yes, sir.
Okay. No more question? Then I'm gonna.
You didn't call my name, sir.
Chloe.
Yeah.
Yeah, I forgot.
It's okay. It's okay. It's okay.
Okay. So any question? Chloe, you can just watch. I would be uploading these videos on the YouTube. You can watch over there.
Yeah. I will try to catch up.
Okay. If no more
Thank
questions,
you.
I'm gonna end this meeting. Okay. Take care. Have a nice weekend. Bye-bye.